Hello, welcome to this episode of Rich Insights. I'm Don Rich, Head of Investments for Esoterica Capital Markets. Today's topic is whether or not post-crisis should equal pre-crisis. In fact, some people have suggested that post-crisis should actually even be better, right? At least in terms of equity prices. Post the coronavirus, equity prices should be higher, right? The argument goes like this. If, now this is a big if, but if you held earnings constant, right, future earnings constant, and you're discounting them now at a lower interest rate, that gives you a higher valuation than we had pre-crisis. Wow, that is an argument. I'm sure you've heard it. It is one of the dumbest arguments I can think of, right? We're talking about the biggest economic downturn in history, but that's what's being espoused. As my father would say, sometimes it's better to keep your mouth shut and let people wonder whether or not you're a moron rather than speaking up and confirming it. I think that's what's going on here. But anyway, what I want to do today is again get at this pre-crisis, post-crisis sort of thing. So the S&P and the Nasdaq have rallied 44% since the March lows. Since March 23, they're up between 43 and 44%, both of them. Right? It's almost identical. 43% run up. Now, has that risk sentiment, right, the improvement in global risk appetite, has that extended to other markets? Well, let's take a look here. We'll start with the currency market. I like to use Aussie yen, right? The Australian dollar versus the Japanese yen exchange rate. That's often used as a risk appetite measure in the currency markets. And you can see this thing has steepened or increased substantially, right? In other words, the Australian dollar is appreciating massively right now against the Japanese yen. And in fact, we are at the highs of the year right now. We've not only recouped the entire pullback, but now we've surpassed it. So post-crisis in the currency market here is actually higher than pre-crisis. All right, let's go on. What about the credit markets? Well, credit markets, here we go. The most recent week, we see triple C's. Their spreads tightened in 150 basis points here. And in fact, we can see the spreads everywhere. The spreads everywhere tighten in, right? So credit tightening while equities rally. That tells you that the risk-on environment has extended to the credit market. Now, we actually have an unusual result right now, right? So triple C's, the lowest rated high yield, has rallied massively, right? And it did last month as well, all right? So it's up 150 in, about 10 days so far this month. It was up nearly 250 last month. So now we've got this really crazy result right now that you see down here on a year-to-date basis. All credit spreads have widened, but the triple C's have actually not widened the most, right? They're the worst. They're the junkiest of the junk, and yet they haven't widened the most. All right, that sort of gives you an idea of sort of just how crazy things are right now. But we have this insatiable risk appetite. 44% run in equities. It's showing up in the currency market. It's showing up in the credit markets as well. Now, not only within equities, right? The 44% run in equities, but now we've gone from the high-quality balance sheet, more tech-related stuff, the higher quality stuff, into everything. Everything. Let's take a look at that. Here we have financials, right? So the financial sector we can see was up over 12% on the week. And it's the banks. Look at the banks here. Whether we use the KBW index is up 17.4% or the S&P 500 bank index up 17.1%. Wow. The banks are up 17%. We had a little bit of yield curve steepening and all of a sudden the banks are suddenly going to be profitable again, I guess. I don't know. You can see it's far less than the other areas here. Asset managers at 8.7% and then the insurance companies at 11%. So the financials are clearly being driven by the banks. All right, so banks up 17% in a week. That's not even the start of it, though, folks. So let's go on to the next one. Airlines. Look at this weekly return on airlines. Nearly 35%. The airline index, the S&P 500 airline index is up nearly 35% in 1 week. Oh my gosh. This is like, the triple C credits again, right? This is just mind-boggling. How things can improve that much in a week. But everything is just flying right now. And surprisingly, the underperformance is actually the Nasdaq. All right, so we've had this huge run-up, right? This huge run-up again for the S&P and the Nasdaq, nearly 44% from the lows. This has resulted in forward PE ratios that we haven't seen since the dot-com bubble, right? So valuations right now don't mean shit. It's just party time. Valuation today on the S&P is about 26, right? That's a forward 1 year PE. 26 on the S&P and 36 on the Nasdaq. Again, numbers we haven't seen since the dot-com era. And that's just crazy. Why has the Nasdaq been underperforming? Right? They had been doing so well for so long. Well, the Nasdaq is up nearly 10% for the year right now. So maybe a little bit of just catching a breather. But also, again, the prices run up so much that if you look at PE ratios like we talked about, the forward PEs, earnings yield, any metrics like that, you'll just see NASDAQ looks horrible, right? The prices run up so much, it just can't stay with the earnings and so forth. All right, let's take a look at NASDAQ versus the S&P. This is another way to see. This is a cross price of the NASDAQ and the S&P. So when we go lower on this chart is when the S&P is getting expensive. All right, look at where we're at today. All right, the blue line again is the daily cross price. And the dotted black line here is where we're at today. The valuation discrepancy between the NASDAQ and the S&P is the highest it's ever been. The highest it's ever been. Again, when you look at cross prices, it doesn't tell you anything about the earnings stream. But both of these being in the U.S., we can there's some neutralization going on there. All we're doing is again pricing one market in terms of the other market. It's the most expensive ever. So we would probably expect the NASDAQ to continue to be the laggard, just like last week, because it has run so far, so fast, it's unbelievable. So if this ridiculous amount of risk sentiment continues and the NASDAQ's not likely to be the big winner, what else is? Well, let's take a look at this. Here we have some more cross prices relative to the S&P 500. Again, not the NASDAQ. NASDAQ charts would even look worse than this. But if we look at EFI relative to the S&P 500, look how low that is, right? Europe and Asia are so cheap compared to the U.S. The MSCI World, ridiculously cheap. Again, much cheaper than they were during the dot-com bubble. And emerging markets over here in the corner. Emerging markets are also very cheap, getting back to sort of the dot-com era. So, I've said it many times. I think this rally has just gotten ridiculous. But last week, we crossed over, right? In the mania just spilled over from the equity markets and particularly hit the currency markets and hit the credit markets as well. So if this thing keeps going, right, I might think it's complete hogwash. Maybe you think it's a complete hogwash. But if it keeps going, my guess is you want to look outside of the U.S. Next. That's where there's catch-up to be played. All right. So we're talking about change of leadership here. We're talking about the NASDAQ and probably the S&P underperforming emerging markets, EFI, the MSCI World, right? Some of these other indices. You want to keep your eye on those going forward. If risk appetite continues at these levels. All right. So that's our message for today. I'm Don Rich, and you've just experienced a rich insight. I hope you've enjoyed it. May your beer be colder than the company you keep. We'll talk again soon. Thank you.